So you're told here, required in relation to pointer and the company's potential acceptance of set a company as a client of the firm. Explain the ethical issues, very common in your exam. Explain the ethical issues and other matters which should be considered. Number two, explain the importance of obtaining customer due diligence, right? And recommend the information which should be obtained. 16 marks. Now this one here is very interesting because when students see figures in the exams, they really panic a lot. You may not even use these figures at all, right? So this company is a producer of greeting cards and a giftware, the demand for which is seasonal in nature. Design costs are mostly payroll cost of the staff working in the company's design team, and the cost related to the design and development of new product ranges. This company has agreed with its bank to clear its overdraft by 1st 2019, and the management team is confident that after that point, the company will not need an overdraft facility. So there is no problem as an auditor doing due diligence. I would really want to know the feasibility. How practical is this? Will these guys be able to repay this amount really as per that time? So if that is the case, then I would want a management representation letter, right? Then of course I'll go to the cash flow statement and I'll look at on that duration, like September, from previous years. Really, have they been having such monies in their accounts, or they want to cheat me here, right? Then I'm told here, the other expenses are calculated based on 30% of projected revenue for the 6 months period. So there's no problem. This is an assumption that they have here. So I'll also check whether this 30%, is it reasonable? Is it a reasonable assumption, right? And for me, I'll be able to get some 2 procedures. So if it's reasonable, I'll be able to recast, I'll be able to recalculate the figures. These other expenses, 3840. So this 3840, 30% of the revenue. They have given me the procedure. I'll be able to recast, I'll be able to calculate myself. So required, recommend examination procedures which should be used in the review of the profit forecast, the profit which is being forecast here really. What procedures in this case should I have? These are 9 marks basically for free, without doing anything, right? So we start with the first one. So we are told here, you are an audit manager. So you are a manager up there, so you need to reason like a manager, right? So you are an audit manager in Pointer and Company, a firm of CPA, which offers a range of assurance services. You are responsible for the audit of this company, a company which provides approximately 10% of your firm's practice income each year. So straight away, I'm able to see, ladies and gentlemen, a threat there. I'm able to see an ethical issue there. Which ethical issue am I able to see there? Ethical issue that I'm able to see there. Ladies and gentlemen, remember ethical threats. Ethical independence threats. Independence threats. Remember the concept of who? Mr. Surface. Remember the concept of Mr. Surface. So where we have this S stands for what here? For self-interest. Self-interest. We have what we call advocacy. We have what we call familiarity. We have what we call the intimidation threat. And then of course we have what we call the self-review threat. So they tell me that I've got a client, and this client, ladies and gentlemen, they are telling me something very important. They are telling me that from this one client, I'm drawing 10% of my audit income from a single client. 10% is significant. 10% I have to be very careful of this client. 10% is quite close to the maximum that I'm supposed to draw from one client. The maximum income percentage that I'm supposed to draw from one client is how much? Is what percentage? Can somebody in this case, in this room, be remembering that maximum percentage of income that I am allowed? I'm not allowed to go beyond from one client. Is there somebody who can remember that percentage? Anybody who is able to remember that percentage? Thank you very much, Howard. It's 15%. If you've got, in this case, for example, 5 clients, we have clients, your clients are here, clients are here. So A, for example, is giving you 5% of your total pie. B is giving you, for example, 10%. C is giving you, for example, 15%. And then we have others there. When you have a client who gives you like 15%, that is against auditing law. It's against. Why? Because you're over depending on one client for your sustainability. When you depend on one client this significantly for sustainability, then you have got every reason to smile when you see their incomes growing. When you see the company doing very well, you've got every reason to be very happy. So you have a financial interest in this company. So you're asking yourself every day, what if in this case here, I give a bad audit report, which may make these people collapse? If they collapse, what will happen? I collapse with them because of the significant amount I'm going to lose, which I normally receive. So here, I'm already at 10% from this client. It means that should I accept any job from this client, then at the end of the day, ladies and gentlemen, what will happen is that I will exceed the 15%. So already 10% is quite big. So I'm starting getting worried. I know that there is an interest threat there, a self-interest threat there, right? So I read this. This is something very important because down there they asked me to raise ethical instances, right? So already I'm bordering on an ethical practice. 10% will easily become 15%. Immediately I take up a new engagement with this particular client. Okay, 10% of your firm's practice income each year. The finance director of Whistler company has recently contacted you to provide information about another company. That is what here, due diligence. Set a company which is looking to appoint a provider of assurance services. An extract from the email which the finance director of Whistler company has sent to you is shown below. One of my friends, Gordon Potts, is the management director of Sasa company. So you can see this guy is a friend. A small company which is looking to expand in the next few years. I know that Gordon has approached the company's bank for finance of $6 million to fund the expansion. To support this loan application, Gordon needs to appoint a firm to provide a limited assurance review on the company's financial statements. You would also want the appointed firm to provide tax planning advice and to prepare both the company and his personal tax computations for submission to the tax authorities. I've asked Gordon to contact you, and I hope that Pointer and Company is your audit firm, will be able to provide these services to set a company for a low fee. For a low fee. So here again, I'm seeing something very bad. They will want me to do quite a lot for very little. So the thing will be, will this business make what we call commercial sense? If it's not profitable, it's not going to be viable on my side, right? Now, if the fee you suggest is too high and unacceptable to Gordon, then I would recommend that Gordon approaches Griffon and the company instead. What is that to me? This is intimidation. This guy is intimidating me. He's becoming overbearing on me. And I would also consider appointing Griffon and the company to provide the audit of Whistler company. Remember, currently you are the audit of Whistler company. I can see now my intimidation threat is getting worse and worse. My 10% revenue is going to disappear very soon. So Griffon and the company is a firm of CCA, which has an office in the same town as Pointer and the company. Now these guys are even messing up my day. They're messing up my everything. Now, ladies and gentlemen, you being an African, given the situation that you're being put in here, will you accept to provide these other services to this new company called Sasa? Being an African, are you like an African? Will you accept or you will refuse? Being an African, what do you think will be the best thing to be done? Yeah, in the circumstances. These guys are putting so many arrows from all sides on you. What do you think, being an African, what do you think will you do in this situation? No, they don't want to talk to me in the morning, so they told us you get to talk to me. Being an African, I will agree, but ethically refuse. Being an African, I will agree. I'll agree because, I mean, you're being pushed to the corner, and remember, there is a very high chance that you're going to lose the 10% audit fees you're getting from this guy, which is what you're very, very, very material, which is very material. Thank you very much, Howard. Great. Now, ladies and gentlemen, we are told here, you've done some research on both Theta Company and the Gordon Ports, the director, right? And have confirmed that the company is small enough to be exempt from audit. Fair, fairly good. The company is owner managed, with the Ports family owning 90% of the share capital. Gordon Ports is a director and a majority shareholder of 3 other companies. An article in a newspaper from several years ago about Gordon Ports indicated that one of his companies was once fined for breach of employment law, and that he had used money from one of the company's pension plans to set up a business abroad. Can you imagine setting up a business abroad and using money of retirees, pension money. You're taking this money abroad. So chances are, when you hear this kind of an arrangement, here there could be a possibility of money laundering. Run away from this business. Run away. Appointing his son as the managing director of that business. So in relation to the pointer and the company's potential acceptance of Sasa company as a client of the firm, explain ethical issues and other matters which will be considered. So we've explained several as we were reading the question, so mine will basically go to the answer here. So ethical and other matters to be considered before accepting Sasa company as a client of the firm. So requirements and guidance relevant to accepting and continuing client relationships is contained in this international standard quality committee. There is a quality committee. You know, nowadays, like last semester, they asked students about things they could not see. There is this quality committee that gives recommendations about the quality standards, the quality processes, international standards, quality committee. 1, quality control for firms that performs audit and review of financial statements and other assurance and related service engagements. The fundamental requirements are that a firm must consider, are we competent to perform the engagement, and whether the firm has the capabilities, including time and resources, to do so. Whether the relevant ethical requirements can be complied with. And then number 3, the integrity of the client, and whether there is information which would lead to conclude that the client lacks integrity. So, ladies and gentlemen, from this quality control committee, you are required always to observe 3 things that if I were you, I will never forget. Number 1, am I competent enough as an auditor to engage in this particular exercise that this gentleman wants me to really look at? That's very important. Are there ethical standards, ethical requirements in this case you must be complied with? Yes. 10% fees, and you want me to take up another job, right? So I may easily exceed the 15%. And here you are intimidating me, right? So there are ethical issues involving this particular involving this particular assignment. And then lastly, the integrity of the client. Like this particular company, they would want me to do due diligence of the director, the owner, this guy who has 90%, potentially could be engaged in money laundering. And of course, he's not a person who is honest, because there is some time back, he took money belonging to retirees and went to invest in a different company being run by his own son. He even had a court case, right? So integrity, very, very important. So competence and resources. Looking at each consideration in turn, there seems no reason why Pointer, the current auditor, why Pointer and the company would not have the competence to carry out the assignment, which is a limited assurance review of historical financial statements. Being a firm of CCA, for our case, a firm of CPA, and performing assurance services, such as the audit of Whistler Company, means that the firm has the relevant knowledge and the experience to perform a high quality limited assurance review. However, the pressure to perform the audit for a low fee could impact on Pointer and the company's ability to perform a high quality limited assurance review. These guys want me to accept a very low fees. So low fees means what? You are not able to provide enough resources for this engagement, right? So a high quality limited assurance review, if insufficient resources are made available, given the potential restriction of the fees which can be charged to provide the service. So this quality control committee, number one, also mentions that where the client is aggressively concerned with maintaining the firm's fees as low as possible, this can indicate a lack of integrity of the client. It's a dishonest people who would want, ladies and gentlemen, really to place you down there. Very honest people know the value of our accountants. They know that these auditors, when they come here, they're going to add value, and as such, we should be able to pay them according to the rates, according to the market rates. Something in this case that is what here? Reasonable. Something which is reasonable. Ethical issues. In terms of ethics, there are several matters to consider. First, it appears that Whistler Company is putting pressure on Pointer and the company to accept the engagement. So there's that pressure coming, right? Whistler Company is a relatively significant client of Pointer and Company, providing 10% of the firm's annual practice income. And there's an intimidation threat that the Whistler Company has threatened to move to another audit provider if Pointer and the company does not accept Sasa Company as a client and perform the work for a low fee. This could also be perceived as a self-interest threat in that Pointer and the company has a financial interest in maintaining a good relationship with the Whistler Company. A further ethical issue arises from the suggestion that Pointer and the company should provide tax planning advice to set a company and prepare its tax submissions. This would give rise to what we call self-review. Self-review. Listen and listen to me very well. Hey, you my good students, listen. These people want me to go ahead and prepare tax computations for this new client. So when I prepare the tax, the same tax figure will find its way to the financial statement. Will find, for example, its way to the income statement, will find its way to the statement of financial position, will find its way to the cash flow statement, right? So when I'm auditing, I'll be looking at things like sales figure like that. I have less cost of sales figure like that, right? So we have our gross profit. Our gross profit is like that. So we come in this case here, blah, 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 profit before tax, and then we say less tax. Tax, for example, we give them a figure of 10 million. So as an auditor, I'm supposed, ladies and gentlemen, to exercise professional skepticism, where I doubt every figure that I'm being given, for me to be able to dig more, to dig for more information that will help me to form an appropriate opinion. So professional skepticism will apply here. I'll be more doubtful because I've never seen this figure before. But when it reaches to the tax figure, who computed tax? It's me. So automatically there is a self-review. I'll get a chance of relooking at the figure that I computed myself. So chances are I will not even do any audit procedure on the matter because, I mean, who doubts themselves? Nobody. All of us in this case, when it comes to us, whatever we do, we always tend to believe that we are perfect. So there is a big threat there of self-review, especially when you are being required to engage in what we call non-audit services. Non-audit services. Non-audit services. Right. So providing tax planning advice could also be seen as acting on behalf of management, further impairing the objectivity of the limited assurance providers on the financial statements. Ladies and gentlemen, when you are offering this tax planning, even tax computation itself, at the end of the day, you're putting yourself under these advocacy issues. Advocacy, right? So at the end of the day, what they're telling third party is there, but these people are paying their fair share of what your taxes. So basically, you're being like an advocate. You are promoting some interest on their behalf. So in future, when they get themselves in problems, tax matters outside it, the auditor will deal with this. There's no way you'll be able to really get yourself off the hook because you did something for them on top of what they're an audit. And that is why, especially in these abroad countries outside there, ladies and gentlemen, you'll be surprised, like in the US, Europe, like UK, if you're offering audit, you can never be allowed to offer non-audit services, right? It's only audit you'll be doing throughout for this one. They can never allow you because of what it is, ethical instances, threats like that. So you have a self-interest. In this case here, these people are being they're intimidating you. There's an advocacy threat. There is a self-review threat. Okay, so you're told point and the company should consider whether safeguards can be used to reduce any ethical threat to an acceptable level. For example, through the use of separate teams to provide limited assurance review and the tax services, and by having an independent second partner to review the work performed. So when it comes to safeguards, yes, safeguard is quite a big term, again, in terms of auditing. Safeguards is a big term. So we are saying that under the safeguards, is there a way as your firm, as in this case, these guys are doing due diligence, is there a way that you could have another independent team, in this case here doing, for example, the tax planning? So basically 2 engagement teams, which presumably are not supposed to be meeting at all, theoretically, right? So that you elect what we call a Chinese wall, very strong, tall wall, in between the two in between the two teams. They should never get to talk to each other. We want these guys here to be very independent between themselves, that they don't talk. They should not talk like that. So is this a safeguard? In this case here, you will consider, yes, it's very practical outside here to reduce the risk. So we are told that if safeguards do not reduce the threats to an acceptable level, then the tax service should not be carried out to the limited assurance review. Client integrity, preparing the personal tax computations of golden pots is less of an ethical issue in terms of objectivity, as his personal tax is a separate issue and not reflected in the company's financial statements. But there may be other issues with providing this advice linked to integrity, which will be discussed later. Listen, ladies and gentlemen, here we're saying something very important, that one of the directors has given us work to do what here, to do his tax computations and filing. So you're saying this one here really is not even about our firm. We can go ahead and do what here, do those computations. But for example, if you realize that this person does not pay taxes very well, you know that automatically exposes you as an auditor. How do you bring up this issue now to the firm without really affecting what here, your relationships? So these are some of the things you're supposed to refuse as an auditor. Tell them, fine, even if you want me to do this personal whatever for you, please, there is this thing that really tells me not to do it. The ISPAC does not allow that. The integrity of golden reports will need to be carefully evaluated. There's nothing wrong with him having business interests in several companies, though information about each of these will need to be obtained. The key issues with integrity relate to the breach of employment law and his son and his taking money from a company pension plan to set up a business which is managed by his son. The breach of employment law indicates that golden reports has a questionable reputation and possibly that he has been involved in criminal activity, depending on which laws have been breached and the seriousness of the non-compliance. The information comes from a newspaper article, so it may not be very credible and may not even be true, and more information will need to be sought on this issue. Taking money from company pension is likely to be breach of the relevant regulations, and it would seem that this is done for the benefit of his son. The fact that this business is located in a foreign country makes the business arrangements complicated, and while it could be completely innocent, it could also mean that there is something more sinister behind the connections between the companies. For example, it could be an arrangement to facilitate money laundering. Of course, this is being supported even by the fact that the company is based abroad. Why could not invest in Kenya or in their country? So Pointer and the company must obtain sufficient information carefully, evaluating the appropriateness of accepting such a company as a client, and they must document the acceptance. They must document, right? The auditor must document. Nowadays, ladies and gentlemen, remember, at the end of the day, you must give us information on those three things that I told you. The concept of competent. Are we competent, right? Are we competent? Are we competent? Do we have enough resources, right? The concept of what here? Integrity. It is, you must always remember to push that thing, the way we said, up there. Number two, they ask us the importance of obtaining customer due diligence and the information which should be obtained. Customer due diligence, CDD. Also called Know Your Client Procedures, KYC, is needed as part of anti-money laundering regulations, which all audit firms should have in place when accepting new clients. It refers to the firm obtaining information to be able to identify who the prospective client is and verify identity by reference to independent and reliable source material. This is a crucial part of risk assessment when taking on a new client, and allows the firm to understand not only the identity of the prospective client, but also the nature of business and its source of funds. Specifically, the firm should address the following as part of customer due diligence. Identify the customer and verify their identity using documents, data, or information obtained from a reliable and independent source. Confirm the identities of all shareholders. Confirm the identities of all shareholders, including specific family members. Leave the percentages out. You must go to the registrar of companies, ask who are the directors of RCM Online College. Identify any beneficial owner. This thing is becoming quite a big thing. Even in Kenya here, the concept of beneficial owners. There is a time the registrar of companies had asked all companies to declare what we call beneficial owners. Because like now this son, they have set up some company for him abroad. Even if they say that this company belongs to the son, we know that the son never invested, never had that capital, right? The beneficial owner, of course, is the father, right? So identify any beneficial owner who is on the client. This is the individual or individuals behind the client who ultimately own or control the client, or on whose behalf a transaction or activity is being conducted. Beneficial owners, right? Where a business relationship is established, understand the purpose and the intended nature of the relationship. For example, details of the customer business or the source of what we have funds. Just get to know how are these guys sourcing their funds. If I don't get to understand how they're getting their capital, then I should run away from this audit, because these guys are thieves and they're going to either recruit me in their cartel, or I'll get myself into bad business, even if I don't engage in theft. If the law comes to know that I was handling a client who was handling these money laundering funds, automatically this puts me in loggerheads with the law. Businesses must also conduct ongoing monitoring to identify large, unusual, or suspicious transactions as part of what here CDD. So anytime you're doing this customer due diligence with a gentleman, it's important, just get the bank statements. Try to see, is there a day that they deposited huge huge chunks of money in a statement in a day. So in this case, I tried to identify these large, unusual, or suspicious transactions. All of the documents obtained for the purpose of carrying out these CDD checks must be retained for a minimum of 5 years from the end of the business relationship. So as an auditor, all those documents in this case here that you obtain, keep them for a minimum of how many years? 5 years. Even after you cease business with this client, don't take those documents to a shredder. Don't do that. If you do that, you'll get yourself into problems and you'll be taken to court. People would want to see really, did you apply, know your client's concept very well. So in this scenario, the information should be obtained that would include confirm the identity of gold ports, photographic evidence, get their passports, and a copy taken along with other means of identification showing his address. For example, recent utility bills or bank statements, individual. Yeah, tell them, you want to give me your 3 months, for example, water bill, electricity bill. So they don't know why you are asking for that. Many times we have been asked for this information and we think that these guys are foolish. No, when you give your electricity bill, that is the best way of confirming your residence, where you're residing, right? In relation to set a company, the company certificate of incorporation should be seen to confirm its legal status, date, and place of incorporation. Take a copy of this certificate of incorporation. A company's house search, in our case, we talk of registrar of company search, right, or equivalent on setup company should take place. This will confirm the existence of the company, the shareholders and directors, and will provide some financial information. This will confirm that Gordon Ports is the beneficial owner of the entity, i.e. that he is the person who owns or controls directly or indirectly more than 25% of the shares, etc. The identity of the other companies controlled by Gordon Ports should also be affirmed, and searches on them conducted to confirm their existence and the nature of the relationship with such a company. The latest financial statements are asked for them, right? Identify the source of funding for the company, right? While not strictly part of confirming the identity of Gordon or his companies, Pointer and the company would clearly need to obtain further information about the breach of the employment law. I would want to go this way. Of course, it's going to be quite rough, but I'll have to ask for this information. Currently, the information available is from a newspaper article, and this may not be credible. Examination procedures on the operating profit forecast. That profit forecast that we saw up there, ladies and gentlemen, what are we supposed to do? The profit forecast. The profit forecast. So the profit forecast that we saw up there under prospective financial information. Under this prospective financial information, PFI is a topic which is also very, very hot for your examiners. When we talk of prospective financial information, ladies and gentlemen, we are looking at what things as auditors. The reliability of the figures. The figures here. So we want, in this case here, to get this PFI, right, information, those forecasts, ensure that, first of all, I get an endorsement from management. The management must endorse these figures and tell us whether they are truthful. They must write down a letter to us, telling us that we collected this information from this source, and we were able to prepare our forecast like that. Of course, I'll ask for a statement of what their assumptions. When they tell me that they assumed, like here they told us that their revenue is growing at 12% per year, I'd have to really ask myself, are these assumptions realistic, right? I'll have to check the competence of the person who prepared. I'll ask the management who prepared this. It's Joshua Aura. Who is Joshua Aura? This other? He's an accountant. He's a CFO. What are his qualifications? He's a member of his PAC, etc., etc. If he's not qualified, I'll straight away say no to them, right? Right. So I'll have to talk to very many people. For example, you tell me that the revenue will grow by 12%. I'll have to ask the sales director whether this is really something that they checked and they're able to confirm the reasonableness. So I'll have, in this case here, to do an interview or just get an email from the sales director confirming that the 12% is manageable. So these are the key small things You test their assumption, reasonableness, achievability. So we are told here, general procedures and require as the identity of the preparer of the operating profit forecast and assess their competence. Obtain an understanding as to the procedures and controls which have been followed in the preparation of the forecast. For example, has the forecast been approved by a senior member of the company's accounting team? So that approval, they should not just bring me something that has been done by a junior accountant down there and they're placing it in my desk. I would want to see some signs, signatures, right? Confirm that the accounting policies are applied. If Visula's company's financial statements have been consistently applied in the preparation of the operating profit forecast. For example, that design costs are expensed rather than capitalized as a development what-year cost. So you're saying, ladies and gentlemen, that even if they are forecasts, if there are areas where IFRS needed to have been used, then we must use the IFRS accounting policies and ensure that they are what-year, they are consistent. Ensure that they are consistent. Ensure that they are consistent. Great. Confirm that the assumptions underpinning the forecast are in line with the knowledge of the business obtained from performing the company's audit. For example, the seasonality of the sales can be confirmed by looking at the audit evidence obtained in the audit of revenue. Recast. Recast means what here? Recalculate the forecasted figures to ensure that they are arithmetically correct. Specific procedures and inquire whether a more detailed profit forecast is available or ask management to prepare one. For example, detailing out cost of sales. You know, they gave me the cost of sales up there. I would want really to dig in and get to see whether we have got more information regarding those items. Very important. From there, ladies and gentlemen, request that management prepares a profit forecast in the same format as audited financial statements in accordance with the IFRS standards, i.e. the interest cost should be shown below the operating profit line, before the operating profit, below, not below, below. So what they're saying, ladies and gentlemen, here is quite something simple. They're saying that ensure that the format is followed. The format is followed according to IFRS. If it's forecasted balance sheet, forecasted income statement, and not relax and say that because it's a forecast, I don't follow IFRS format. No. So if you have the operating profit, which is profit before interest and tax, come and have what here? Less interest after. Below, less interest, like that. So I want to ensure that the format is followed straight away or through. Great. Now, so gentlemen, from there, we are told here, having obtained the cost of sales figure for each 6 months, recalculate the gross profit yourself. Compare this gross profit margin in the prior year, audited financial statements, and investigate any anomalies. So basically, they're doing the analytical procedures. They're analyzing their computing ratios, and they're, of course, trying to see whether, trying to investigate the differences. Having obtained a breakdown showing the components of cost of sales and other expenses for each significant category of expense, perform analytical review to confirm that the forecast costs appear to be in line with expectations. Based on the above, assess whether there are any missing categories of expenditure which have not been included in the forecast, e.g., there is no depreciation. Right? For revenue, which is forecast to increase by a significant amount of 11.8% increase comparing to the 6 months like that, consider whether the forecast appears overly optimistic, whether it's reasonable, right? Compare the revenue in the year forecast to that in September 2019, the revenue from prior years, audited the financial statements. Again, in this case, you're trying to ascertain the trends. Review any marketing plans and discuss with an appropriate senior member of staff, for example, the sales director, to establish the rationale for forecasting a significant increase in revenue. For example, there may be plans to introduce new products. Consider this in light of the fact that design costs and marketing are not forecast to increase by, this is something that you can easily see. Confirm costs to appropriate supporting documentation. So ask for vouchers, right? ask in these cases and gentlemen, especially the historical ones, whether we have this payroll. Trace them even to the bank statements, right? Because remember, forecasts are normally prepared from historical. You take the historical figures. So look for support documentation. Assess whether the overdraft is likely to be repaid in September. For example, by obtaining and reviewing the cash flow forecast prepared for the same period as operating profit forecast. Discuss whether with management, the rationale for using 30% of revenue as a basis for determining the amount of other expenses. So in addition, compare this to the results of audit procedures performed on expenses to gauge whether 30% appears to be a reasonable basis. Remember, these were among what here? The assumptions. These were among the assumptions that we had up there. Remember the 30%. So, ladies and gentlemen, whenever it comes to this prospective financial information, it's more to do with what you're not so sure. We don't know whether those things are going to be like that, the forecast given. So I'll have to do a lot of discussions with management, ask for a representation letter, have in this case here the competence of the person who prepared this as a thing. Have in this case here, for example, they are telling me that sales will be growing by 12%, almost 12%. I have to confirm this with the sales director. Let him give me a concrete evidence that the 12% is achievable, right? For any assumption they have given me, like the 30% assumption, I have to get it. Those figures are 30% of revenue, so I have to recast, I have to calculate, right? So it's very important. We keep on, in this case here, making inquiries, doing comparisons. This year sales vis-a-vis last year sales, are the trends really reasonable? Are they going to be achieved? etc. So it's about, of course, as usual, not cramming. Don't cram. It's about you having general knowledge, which you can use to tackle your exam. Thank you very much. See you tomorrow. Bye-bye.